Hi, I'm Dong Xiong. Welcome to Digging into China, where we explore China in depth to review unique perspectives. China's macroeconomic data for April has been gradually released. Today, we'll analyze the published figures, focusing particularly on financial data. To be frank, April's financial data is shockingly dismal, almost beyond comprehension. To begin with the loan data for small and micro enterprises. At the end of March, their outstanding loan balance stood at 35.3 trillion yuan. By April's end, it had fallen to 34.3 trillion yuan. In just 1 month, the loan balance for these businesses dropped by a staggering 1 trillion yuan. This is unprecedented, truly unheard of. A 1 trillion yuan decline in loan balance in a single month indicates that the small and micro enterprises took out no new loans during this period and were instead frantically repaying existing ones. Such an extreme anomaly cannot be attributed to these businesses voluntarily settling their debts. The only possible explanation is that amidst the escalating U.S. China tariff conflicts, commercial banks have refused to extend the loans to private enterprises in the export sector. Moreover, they've abruptly shifted to demanding immediate repayment, pressuring these businesses to settle loans early. This alone accounts for the dramatic 1 trillion yuan drop in loan balances for small and micro enterprises in April. Supporting loans to private and small business is a declared national policy of the Chinese government and a key priority loudly championed by the People's Bank of China, PBOC. Yet, as soon as the U.S. China tariff conflict intensified, this commitment was swiftly abandoned. China's banking system is a peculiar one. At its apex is the PBOC, nominally a ministry-level institution under the State Council. But in practice, its political influence is akin to that of a minor administrative unit. The PBOC's department heads are typically overseas educated finance experts from modest backgrounds, essentially a group of studious technocrats lacking elite political connections. In contrast, the leaders of China's major commercial banks often hail from politically powerful families, wielding substantial influence and genuine vice ministerial authority. Directives from the PBOC are frequently met with indifference by commercial banks, which often treat them as mere suggestions. These banks follow their own operational logic, prioritizing risk management over the rationality or legitimacy of national policies. The PBOC and the commercial banks are rarely aligned. Given its limited political clout, the PBOC has little to no sway over the major commercial banks. From the PBOC's perspective, in a critical moment like the U.S. China tariff conflicts, it would be unthinkable to undermine businesses or betray their trust by forcing export-oriented private enterprises to repay loans prematurely. Such actions are utterly reprehensible, tantamount to self-sabotage. However, from the commercial bank's standpoint, pressuring these private firms to repay early is a rational decision. It's the only way to mitigate operational risks and avoid a sudden surge in bad debts. In this context, the commercial banks have clearly prevailed, while the PBOC's commitment to supporting private enterprises has been cast aside. Next, let's examine the social financing data for the first 4 months of this year. Starting with the PBOC's report on the increase in social financing scale. First, consider monthly loan growth. January saw over 7 trillion yuan in new loans. February, affected by the Lunar New Year, dropped to around 2 trillion yuan. March rebounded to over 5 trillion yuan, but in April, as the U.S. China tariff conflicts erupted, loan growth plummeted to just 1.16 trillion yuan. A month-on-month decline so severe it defies easy calculation. Breaking down April's figures, the new renminbi loans amounted to a mere 88.4 billion yuan, a stark contrast to the previous 3 months. Other subcategories fare no better. Foreign currency loans, entrusted loans, trust loans, and bank acceptance bills all recorded negative values, reflecting a sharp contraction in commercial activity in April. Corporate bonds posted a positive 234 billion yuan, but this is largely because only local government financing platforms issuing urban investment bonds can still access this market. As for government bonds, national and local bonds issued by the Treasury, the net financing scale reached 972.9 billion yuan. Other categories are negligible and warrant little attention. This reveals a harsh reality. In April, financial activity across the nation effectively stalled. Commercial banks are aggressively pressuring private enterprises to repay loans, leaving government entities as the only ones still able to borrow from the financial system. Turning to the renminbi loan data for the first 3 months of the year, the first quarter showed a respectable performance. January recorded new loans of 5.22 trillion yuan. February had 652.8 billion yuan, and March reached 3.82 trillion yuan. In total, the first quarter's new loan scale amounted to 9.7 trillion yuan, a 6.4% increase over the 9.1 trillion yuan from the first quarter of 2024, a seemingly solid result. But how much of those 9.7 trillion yuan in loans went to private enterprises? This figure would truly reflect China's commitment to its private sector. Such data is rarely published and typically hard to obtain. However, at a press conference in late April, the PBOC disclosed that new loans to private enterprises in the first quarter totaled 2.4 trillion yuan, with an outstanding loan balance of approximately 45 trillion yuan by March's end. This allows us to gauge the financial system's prioritization of private business. In the first quarter, total new loans nationwide reached 9.7 trillion yuan, with 2.4 trillion yuan allocated to private enterprises. Simple division yields 24.7%, the true share of private enterprise in the financial system. By the end of March, the total loan balance for all enterprises was 180 trillion yuan, with the private enterprises accounting for 45 trillion yuan, or 25%. These numbers align precisely. Thus, it's clear that private enterprises represent just a quarter of the financial system's business, hardly a priority. Following the April escalation of the U.S. China tariff conflicts, private enterprises were effectively abandoned by the financial system. Banks forced early loan repayments, pushing these firms to the edge to prevent the loans from turning into bad debt. This is the true operational logic of China's financial system. Beneath the polished rhetoric lies a brutal truth. Private enterprises are the backbone of economic vitality, capable of efficient investment, job creation, foreign exchange earnings, and consumption growth. They stand on the front lines of the U.S. China tariff conflict. Unlike a military conflict which relies on state forces, this tariff war depends on thousands of private export-oriented enterprises. Yet, ironically, as soon as the conflict intensified, the financial system cut off their support, demanding debt repayment. In essence, this amounts to a collective betrayal by China's banking system. While soldiers battle on the front lines, their weapons are seized, forcing them to charge unarmed into the enemy's onslaught. The audacity of this behavior is unprecedented, utterly deplorable, and deeply unsettling. The final data set concerns the investment multiplier, which measures how much fixed asset investment each yuan of new debt generates. In 2015, this multiplier peaked at 3.6, meaning 1 yuan of new debt drove 3.6 yuan of investment. Since then, it has declined sharply. By April this year, it had fallen to 0.9, meaning 1 yuan of new debt generates only 0.9 yuan of investment. The missing 10 cents is absorbed onto a cycle of borrowing to repay old debts. When debt growth exceeds investment growth, the debt becomes fundamentally unpayable. This underscores a grim reality. As the banking system abandons private enterprises and relies solely on government borrowing, China's financial and investment activities have lost their dynamism. The entire system teeters on the brink of collapse. Analyzing April's data lead to a stark conclusion. China's economy risks a sudden breakdown at any moment. Yet, the National Bureau of Statistics paints a different picture, proclaiming the national economy withstands pressure and grows steadily. Sound familiar? It's the perennial China's economy triumphs again narrative. Why then does the Communist Party cling so stubbornly to appearance, manipulating data, tightening fiscal policy, and resisting reform, even as the economy grows increasingly unsustainable? What drives this? I've long believed Xi Jinping lacks a deep understanding of history, even that of his own party. The errors he's repeating are ones the Communist Party made decades ago. To stumble over the same mistakes is frankly indefensible. In the late 1980s, China was in the early stage of reform and opening up. Transitioning from a planned economy to a market one wasn't as simple as issuing a decree and creating a free market overnight. It was a chaotic hybrid. On one side, the planned economy persisted. Grain, coal, and steel had state-controlled prices absurdly low. On the others, markets were emerging. Farmers could sell produce, urban residents could open shops, and goods in the free market followed market prices. This created a bizarre phenomenon. A ton of steel might cost 100 yuan at the state price, but 300 on the open market. Those with connections could secure a quota, buy at 100 yuan, and sell for 300% profit without effort. This birthed China's first wave of new rich, the speculators. They didn't produce or innovate. They thrived on connections and information gaps. Ask them where the steel came from and they wouldn't know, but they knew who controlled the quotas. The downside, ordinary people couldn't access affordable goods and faced high market prices. Businesses struggled to compete with those holding quotas, leading to market chaos and widespread discontent. The Communist Party, determined to showcase the success of reform, demanded soaring GDP and impressive economic data. Local governments launched projects indiscriminately. Industrial parks, train stations, chemical plants. Business expanded recklessly, heedless of market demand or return. But these projects require funding. With limited fiscal revenue, where did the money come from? The PBOC printed, and state-owned banks became cash dispensers. Loans were issued without regard for a project's profitability or even its existence. Just a proposal was enough. The result was a nationwide GDP race, with hard money flooding the system and dubious projects proliferating. By 1988, China's M2 growth rate exceeded 30%. Money supply spiraled out of control and inflation surged, with CPI surpassing 20%, entering hyperinflation territory. As the situation unraveled, then Premier Zhao Ziyang proposed a disastrous solution: fully liberalize prices and end the dual-track system. The outcome was predictable. With hyperinflation devaluing money daily, people rushed to withdraw cash and buy goods. Banks faced runs and closed their doors. Store shelves emptied and a panic gripped the nation. Only then did the Communist Party recognize this error and halt price liberalization. It's no exaggeration to say that the Tiananmen Square protests of 1989 were directly linked to the hyperinflation and the failed price reforms of the late 1980s. Economic instability fueled political unrest. What was China like in the early 1990s? Public confidence had crumbled. State-owned banks were mired in losses. Bad debt ratios reached 30 to 40%, and no one dared reveal the true state of affairs. Policies shifted abruptly, reforms stalled, and the economy entered a deep freeze. The late 1980s served as a warning to the Communist Party. Pursuing vanity projects and chasing rapid glory is a dead end. Back then, runaway inflation and soaring prices sparked public outrage. The government's panicked price reforms failed spectacularly. Today, it's deflation, stagnant consumption, and a shrinking investment. Yet, Xi Jinping persists. He's attempting another round of price reforms rebranded as stimulating domestic demand and boosting confidence. How? Let's examine his actions. First, he launched a nationwide trade-in program for consumer goods, urging people to replace functional refrigerators, washing machines, and air conditioners. Framed as a green initiative, it's really a tactic to inflate consumption data and nudge CPI upward. Visit China's major e-commerce platforms and you will see substantial government subsidies for electronics. Second, he's pressing local governments to boost investment and stimulate domestic demand. How? The familiar playbook: special purpose bonds, urban investment companies, mixed ownership reforms for state-owned enterprises, and the PBOC support. The projects are recycled ideas. The funds flow in the same direction, same strategy, new packaging. To keep local governments stacking up economic data, Xi has permitted debt restructuring, allowing them to borrow to repay old loans while building infrastructure and high-tech projects to maintain an attractive growth curve. How does this differ from the 1980s, when thousands of chemical plants were built? Today, it's thousands of chip factories, digital economy zones, and smart manufacturing bases. The objective remains unchanged: make the numbers look good. More audaciously, Xi speaks of boosting confidence, uplifting, right? But examine the methods. High unemployment, no issue. Alter the statistics and stop publishing data. Low consumption, adjust last year's baseline to make this year's growth appear stronger. Waning business confidence, issue directives, hold motivational meetings, and deploy task forces to manufacture optimism. Ultimately, GDP growth must hit 5%. Anything less is unacceptable. This is a deflationary economic illusion, driven not by genuine purchasing power or structural reforms, but by administrative mandates, artificial consumption, and orchestrated prosperity to mask the economy's fractures. Yet, walk any streets in China and the reality is stark. Restaurants are empty, with more staff than patrons. Office buildings stand vacant, entire floors unused. Shops close one after another, and the landlords can't find tenants even at the reduced rents. How does this differ from the late 1980s? Then, it was runaway inflation and a failed price reform, with the government blaming the public. Today, it's deflation and a stalled consumption, yet the government still points fingers at the people. The core issue is the same: refusing systemic reform, prioritizing performance over solutions, and chasing appearances over substance. Where does this path lead? The answer is straightforward but sobering. China's economy won't collapse abruptly like Latin America's, but will slowly erode, drifting towards a mini Latin Americanization. GDP growth will continue, driven by investment, but its quality will decline. Cement traded for numbers, infrastructure for symbols, while real consumption and production vitality fade annually. Local governments will appear to manage debt, but their financing platforms will become zombie entities, perpetually rolling over unpayable loans. State-owned enterprises will expand, private firms will grow cautious, innovators will dwindle, and policy followers will proliferate. The market will lose its entrepreneurial spirit, replaced by those chasing government cues. Data will show deflation easing, CPI turning positive, and the PMI consistently above 50. But on the streets, shops will close, office buildings will empty, young people will leave, and the government will still proclaiming the economy is stable and improving. This is China's mini Latin Americanization, not an Argentine-style debt default or a Venezuelan currency collapse, but a tightly controlled, market-weakened, superficially stable yet increasingly dysfunctional system. The more the government intervenes, the slower the economy moves. The better the numbers look, the grimmer the reality. Ultimately, China won't collapse, but it won't be revitalized either. It won't perish from war or disaster, but from repeated vanity projects and a refusal to reform, reflect, or adapt. A slow decline in tepid waters. Xi Jinping's policies are steering China back to the 1980s, when it struggled to transition from a planned to a market economy. Now, he's pulling the market economy back towards a planned one. Not the old ration ticket system, which is impractical, but a new form of planned economy. How does it differ? The old planned economy set production, supply, and the prices. Xi's new planned economy maintains nominal market pricing but dictates industries, investments, and growth targets. Previously, state-owned enterprises dominate. Now, they lead while private firms are marginalized, and the large private companies are essentially state-controlled in disguise. Prices were once state-set. Now, they are manipulated through subsidies, controls, and window guidance. It appears to be a market economy, but it's a re-engineered planned economy at its core. In essence, the old planned economy directed production through plans. The new one cloaks markets in administrative control. It seems like a market logic operates, but resources follow policy. Business decisions await leadership approval, and the capital flows align with the guidance documents. You believe you are competing in the market, but you are chasing political signals. You think you are innovating, but you are completing project applications. You assume the state is fostering new industry, but it's a state-owned enterprises and conglomerates reconstructing a planned system in modern guise. The masterstroke: this new planned economy is cloaked in legitimacy, branded not as a return to planning, but as high-quality development, a Chinese-style new national system, and market mechanisms guided by top-level design. At its core, it's the old planned economy dressed in innovation's garb, bearing a market's label and orchestrated by administrative fiat. If Xi Jinping remains in power for another 20 years, the next 2 decades will see China rigid yet not dead, gradually bleeding out. For at least the next 20 years, meaningful reform is unlikely to materialize. Thank you so much for watching. If you find this video helpful, please like it, drop a comment below, and hit the subscribe button right here. It really helps YouTube suggest my videos to others. I'll be back with more content soon. Until then, be well.